Okay, welcome everybody. We're so glad you're here. I'm going to talk for about 20 minutes tops on where we get our information and how we use it. There's no secret here. So there's no secret information, but we thought y'all would benefit from where we go read, where we look, where y'all should look, and where you shouldn't look. And then our process. We want to talk about our process, about how we make these decisions, and like in times like this, how we stay disciplined on what we're doing, because it's a trying time and we're all victims of behavioral finance. Behavioral finance is, for the last 3 to 5 years, the markets have just been going straight up, and we're like, this is fun, this is good. Boy, I sure hope this lasts. We know it doesn't. So we're paying for some of the gains that we've had over the last 4 or 5 years, but we'll talk about why that's happening and what we see moving forward. As I mentioned before, this is going out over the World Wide Web, so if you know someone who might benefit from this, please forward it to them. We'd love to have a conversation with them about what we're doing or what's on their mind. So let's get started. Where I am. Just as a reminder, this is our inverted triangle where asset allocation provides the most value. Asset allocation is based on your risk tolerance and your time horizon. Then portfolio construction, how you put together a portfolio for tax purposes, etc. Investment vehicle, what do you use? Do you use mutual funds, stocks, individual bonds, individual investments? And then down at the very bottom is stock picking or security selection. And that's the most overvalued and underappreciated from a bad standpoint use of selections. And then the next one is, as many of you know, total return is equal to income plus capital appreciation. So what we try to do is our core strategy generates total return by making money, investment income, in the form of dividends, capital gains, and appreciation. And rather than solely relying on capital appreciation, which, as you know, over the last 9 months would not have been good. And then this is called the efficient frontier. Every portfolio sits somewhere on the efficient frontier. Our attempt here is to minimize risk and maximize return. So that's where you fit there. Most portfolios do. So let's get started. Where do we get our information and how do we use it? This is not going to surprise most of y'all that we are very systematic. We've got a process so that we're not person reliant, we're reliant on the system. And so on a daily basis, we all research and we all read. Not just me, not just the partners, but Sharon, Billy, Mary, everybody is reading and looking, and we come together and we share those ideas. Because not only do we read different things, but people are going to pick up different topics when they read different articles. So we try to spread the wealth and make sure on a daily basis we're researching and reading daily. Then every week at 9 o'clock on Monday morning, we have a staff meeting. And in that staff meeting, we review individual positions, whether they be stocks or mutual funds, and we look at how they're performing and are they doing what we tasked them to do and why we bought them in the first place. So on a weekly basis, we look at probably 90% of our positions and make sure they're on task. We also have a rolling review of client portfolios. So everybody's portfolio gets looked at by the entire team on a rolling basis. And when we look at those portfolios, we're looking at performance on a 1, 3, and 5 year basis. We're looking at their asset allocation. So are we taking too much risk or too little risk in the portfolio? And so as we go through an annual basis, everybody's portfolio gets looked at by everybody, which brings a lot of eyes to bear on it. And then on a monthly basis, we have our investment policy committee meeting, or what we refer to as the IPC. We just had this last Monday, and the 4 partners get together, and Sharon is typically our note taker, and we pull it all apart. We talk about how our portfolios are doing, particularly in regard to what's happening in the environment. What are interest rates doing? Should we be going long interest rate, short interest rate? What's undervalued? What's overvalued? That's where we dig it apart, and often we'll have some somewhat heated discussions, but that's very good because we're all bringing our ideas to the table and making sure nobody's an outlier and everybody's position's heard. It's very good for all of us and very good for our clients. So I want to walk through specifically, and maybe while you're here, where do we go for information? So Morningstar is a paid service. You've probably heard of Morningstar. You can go search things on the web. This is a paid service that I would not recommend you buy because it's very expensive, but it's also incredibly detailed. We can go analyze ETFs, exchange traded funds, stocks, mutual funds. We can go read articles. You can't read this, but here's one of them. Why are U.S. equity fund managers performing worse? Or economic growth may be slowing, but is yet to contract. So there's tons of data in here, but there's also good articles. This is not something that would keep you awake if you started reading it. But we nerds enjoy it. And also there's so much information in here, you have to learn how to use, it's called Morningstar Office that we have. You have to learn how to use it to even get to the information. But there's incredible depth here. You can see here topics, there's videos, there's bookmarks, there's just tons and tons and tons and tons of data in here. And this is just a screenshot of their website that we log into. But that would be the starting point, the anchor for where we begin a super detailed dive on what's happening, what we think is going to happen, what other people are saying as well. So Morningstar Office. Then Barron's. Many of you may have heard of Barron's. This is a site that would be good for you. It's a pay site, but you can go on here and get a general idea of what's going on. Up here at the top are all the indices, Dow Jones to futures, and then there'll be some articles such as inflation rose more than expected, the Fed's work isn't over. I'll caution you about Barron's though, because Barron's will address individual stocks, which is all well and good, but that's why I showed you that upside down triangle. Trying to be a stock picker or stock selection is the least added value in financial planning and investment. It's the sexiest, it's the one that gets the most conversation, but when you look at historical averages, trying to be a stock picker typically does not result in good performance. So it's a very good site, but you can't see down here, again, this is a screenshot of their website. There'll be articles about NVIDIA or Ford or something and why you ought to buy or sell it. But again, a good place for education for someone who is trying to learn more about the financial markets, just with that word of caution on stocks. This is my favorite, and this is the place that I think most of y'all should go to and get a lot of good information. For a couple reasons. One, there's some cool stuff in here. Besides finance, there's life and style and real estate and sports. But there's articles in here that are educational in nature. So they don't just tell you what's happening to the Treasury, they tell you why, or the Treasury bill. and the articles are typically no longer than 5 or 6 minutes, and they're really well written. The opinion section or the letters to the editor are always entertaining in the Wall Street Journal. So as you'll see, when I do my recommendations, this one is probably the best one, and again, the most entertaining, and that would be where I would start. By show of hands, does anybody have a subscription to the Wall Street Journal? Right. Is it digital or paper? Oh, good. Okay. You?
I just do paper on the weekend.
Do y'all like it?
Yeah, it's a ritual.
Yeah. Educational?
Oh yeah.
Yeah. Good. And when you read stuff like that, when you come into the office, you ask us better questions, which is great because an educated client is a good client. If we're trying to educate clients and tell them things, that's not good for them and that's not good for us. We're happy to do it, but this is really good. And we like to be challenged sometimes as well. So Wall Street Journal, definitely one I would look at. If you don't have a subscription, get one. So Schwab, here is a screenshot of what we call Schwab Institutional. As many of you know, that's where we custody our assets, or a third party holds your investments there because we don't want to hold them. But as a custodian, They provide us tremendous amount of information. You can see some of these headers hopefully on fixed income, mutual funds, market reports, calendars, sectors. A lot like Morningstar, in depth, but just a different flavor. And when we go into Schwab, down the screen, you can't see it, there will be reports from other investment companies. So it's not just Schwab. They'll also pull in some Morningstar, they'll pull in a group called Argus, they'll pull in some other investment managers where we can go get another perspective through Schwab. And that's a good point. None of the things I'm going to show you, we exclusively read. We look at an article and there may be a contradictory article someplace else, so we take that into account. We're reading all of these and trying to use them and piece them together. But you will begin to see themes. And when you see a theme, you go, okay, that bears more research, which is good. We're nerds. Yeah. Kiplingers. Anybody heard of Kiplingers? Okay, great. Kiplinger would be a great resource for you guys. Sharon tells me it costs
$117
okay,
a year.
a year. And it comes out weekly, either electronically or paper. But it'll talk about, you can see here, it talks about politics, it talks about the economy. There'll be certainly finance in there. They've got a great tax section. So you go in there and they'll talk about things like I-bonds. So we sent out a blog probably in March, April, and so you can go buy $10,000 worth of I-bonds and you can get a great interest rate on them. We can't buy them for you. You have to go through the USTreasury.gov to do it, and you're maxed out at $10,000. But when we read that, we knew about them, but there's kind of a how-to in the Kiplinger letter about how to go do it. So really kind of blue collar almost, but how to. It's 4 pages, comes out weekly, and very, very, very good. Very good. So JP Morgan, this is not what I would encourage you to go read because you will fall asleep. But from our perspective, they manage assets primarily on an institutional level. So much higher and much bigger numbers. But just this morning, I was listening to a webcast that JP Morgan put on by Dr. David Kelly, an Irishman. And it's funny, they have great information, but they'll very rarely make a prediction because they don't want to be pinned into a corner in case it's not successful. But they'll talk around a lot of topics and you can still get good information about it. Like this morning on his webcast, he said, well, in his Irish brogue, inflation's probably going to stay elevated or the same for another month or two, and then we don't know what's going to happen. We got a PhD in finance.
Yeah.
That's why I'm here. You know? But that's a place we go, and there's a guide to the markets, lots of great information that they make available to us. All right, podcasts. Anybody listen to podcasts? Okay. 2 great podcasts. One's called Barron's Streetwise with Jack Howe. I'm going to play you a couple of clips from both of these. It's not only educational, it's very entertaining, as you will hear in just a second. And then this comes out once a week, and it usually lasts, it's about 20, 25 minutes. And then Wall Street Journal, What's News, and we'll send you links to all these so that you can go get them if you want to. That is a morning podcast and an evening podcast. And it usually lasts 15 to 20 minutes. And it just hits the headlines, and then we'll dive deep into a couple of them. Really good stuff if you want to get a view and then go read and dig into something. So let me play you a couple of clips from these, just to give you a flavor for them. So this is Barron's Streetwise podcast, and I'll give you a little background to it. This was last week when they had just introduced the new iPhones and the new Apple Watch. So Jack Howe, who's the senior guy in the podcast, is talking to Jackson, who's a Generation Xer, who's his producer.
Listening in is our audio producer, Jackson. Hi, Jackson.
Hi, Jay.
Did you see the new Ultra watch that Apple introduced this past week? And should I order one? And why is the answer yes?
I think you should get it because that's definitely the next step to becoming an elite athlete.
I'm almost there. My watch, and I'm gonna be 50 in a few days, so it's a midlife crisis, and I'm not getting a pricey convertible or anything like that. So I think the watch might be it. All I have to decide, the only decision you have to make is which band, and there are 3. Which one do you like for me?
The ocean band, like these look, it looks like an accordion. It says, the tubular design allows it to flex and stretch even over a wetsuit.
I think what they really mean is fat wrist, but okay, let's call it a wetsuit.
How many people do you think are in a wetsuit using these watches?
0. I think it rounds to 0. I think there are no elite athletes buying these watches.
These pictures, they're over the top. Like this guy looks like he's on Mount Everest. The trail
Yeah.
loop, a guy's running down a sand dune. And the
Right.
ocean band, you got scuba divers.
I'm all of those people in my head, but in reality, I'm in the drive-through line at McDonald's.
I think that means you should get all 3 bands.
So you kind of get a flair. They go into talking
Okay,
about.
so Apple this past week hosted its year.
They go into talking about Apple, so they do get serious of whether it's a buy and what's happening in the market. But it's incredibly entertaining because of the banter between the old guy and the young guy. And so whenever you can have something that's entertaining and a little bit educational, it's always good. I'm going to play a little clip from the Wall Street Journal, What's News as well. A little more serious.
Amazon Business. Buy smarter. Dream bigger. Amazon is facing a major legal challenge in California, and voters, once reliably Democratic, are moving toward Republicans. What's behind the change and could mean for the midterms?
The shift of Latino voters is one of the most important things that has arisen in politics in the last year. It has the potential to really reshape what each party's strategy is for becoming the dominant national party.
Plus, workers are coming back to the office, and things are getting a bit tense. It's when
So headlines last maybe 15 minutes, but it'll plug in those topics that you just heard. They'll pull them into financial and how it affects the financial market. So 2 excellent ones that I think will be entertaining, but also will be helpful and probably explain some things that sometimes we tend to talk up here. I know that, so this is helpful. So where should you look for information and where should you not? So we talked about the Wall Street Journal, Barron's and Kiplingers, and that's the order in which I would start. So number 1 would be the Wall Street Journal for the things that we talked about. It's going to be written in a language that's understandable and fun. And then as you read it, you will say, I like this, I don't like this, and you just kind of develop a way to almost read it yourself. For those of you that have it, you probably go, I know I want to read this, and there's usually good information. Barron's and Kiplingers are kind of the same. Again, Barron's is going to be somewhat stock focused, but good information in there. And Kiplingers is not going to be as quite a deep a dive, but excellent information in there. Where you should not get information, just like in the Reagan era, television, just say no to drugs. Just don't bother, because TV is in the business of selling advertising, not giving good advice. So when you watch MSNBC or Fox Business or something, they're talking loud and they've got people moving around and they got one person over here saying this is a great investment and they got somebody else over here saying this is a terrible investment, and they're creating drama and they're creating confusion and they're selling advertising. So your head begins to spin, and I don't mean they're all that way, but when I watch very few television series and that comes on, it's just confusing, and there's so much information and so much data out there now. We don't need confusing, we need good facts. Okay, so often opposing views are presented to create debate and drama. And I don't know about y'all's life, but I have enough drama in my life that I don't need anymore, and I certainly don't need it on television. And then I'm going to wrap up with just a little financial market intel and a little update. So as you all know, interest rates are moving up. They're moving up very quickly. Part of that is inflation. Part of that is the Fed trying to fight inflation. that is the reason that we've seen, not the only reason, but a major reason we've seen a downturn in the equity markets. For those of you that have been clients for a while, you heard us say for the last 3 to 5 years, this is not normal, this cannot continue. We didn't know when it would happen, but we knew at some point we had to come back to the mean. Well, as interest rates began to rise, because the Fed was raising rates, but because also we've not had inflation for 40 years. We just have not had meaningful inflation. Now we have some. Well, as interest rates rise, bond rates rise as well. So now those stocks that were paying a 2.5% dividend yield, today, I just looked at the numbers before we came up, you can buy a 1-year US Treasury note. So that's a note issued by the US government. There is no risk to it whatsoever, because if they don't pay their note, it doesn't matter about your portfolio, it matters about guns and bullets and bread, because we're in anarchy. But you can buy a 1-year US Treasury note now, it'll pay 4%. Yeah.
It's scary, you think that's good. That's what's so amazing.
Right, well, and compared to 2 years ago, we were not buying treasuries because a 10-year treasury would pay 0.6%.
Yeah.
And a 1-year treasury would pay 0.2%. So what's happened is those rates have risen so fast, that's why the market has tanked so quickly. Because when you look at what you can make on a 1-year basis versus dividends, you go, well, there's no risk in buying that 1-year treasury. I can make a dividend on my stock or my mutual fund, but there is risk that it's going to go down. So it makes for competition, and that's a lot of what's going on. That's also a tailwind for fixed income and bonds. When those normalize or flatten out, nobody knows. But inflation is not here forever. I just made the mention that we haven't really had meaningful inflation in 40 years, since the late 70s and early 80s. We certainly have had zero over the last 10 years, zero inflation. And that's borne out by, I just said, the 1-year US Treasury note, which is a risk-free note, is paying almost 4%. Guess what a 10-year US Treasury note is paying, you Wall Street Journal readers? 3.5%. So compute that. You go out 1 year and you make 4, but you go out 10 and you're only going to make 3.5? Why is that? That's because the bond market that sells these notes knows interest rates are not going to remain elevated forever. They're going to come back down. And in that podcast I was listening to, or the webcast I was listening to today, David Kelly said, it may not feel like it, but we've really kind of leveled out on inflation. The market did not react well early this week to a slight uptick in jobs claims, but inflation stayed about the same. So at some point it's going to turn over, and when it does, stocks will perform better. They're probably not going to go back to making 21 or 35% or things like that. But the historical norm, I hate to be the bearer of bad news, but the historical norm of equity is 8.5 to 9%. And y'all saw what Amazon and Tesla and all those things were doing. It's just not sustainable. Just not. So,
Take 8.5.
Yeah. Well, and when we look over time, now that's 100% equity portfolio is going to make 8.5. So most importantly, we have a gift for y'all. And the gift is, you guys don't get the gift, is a subscription to the Wall Street Journal. So if we're going to tout this to y'all and we're going to recommend you read it, we want to give you a gift of a subscription to the Wall Street Journal. So we'll get in touch with you and show you how to do it. And as you read those articles, send us an email, contact us and say, hey, I saw this, tell me more about it. So it's a win-win. We think you'll be educated, you'll enjoy it too, because there's some really, as y'all can attest, good articles in there that have nothing to do with finance. And when we're having a drink or something, I'll tell you one that I found. So with that, I'll take questions about the markets, about what we talked about here, anything that we might be able to help you with. We are incredibly grateful to all of you for allowing us to help you and the confidence that you placed in us, because it's been kind of scary over the last 9 months, but it's not going to last. And as we say, you've heard us say many times, if you were in the right place when you entered this, you're gonna be just fine.